Hello, I'm going to be going over how to build wealth like a Rockefeller. The Rockefeller family is known for amassing a net worth of $360 billion, starting from nothing. So, today I'll be going over some strategies the Rockefellers utilize with trusts as well as permanent life insurance, whole life policies to create, keep, and compound their wealth. Please like and subscribe. And also, I'm a licensed real estate agent in New Hampshire. So if you're local to the New Hampshire area and looking for a real estate deal, email me at portercap, PORTERCAP01 at gmail.com. The Rockefellers are a prominent American family, first taking on their fame in the 1800s with John D. Rockefeller Sr. They're known for their contributions to philanthropy, business, as well as politics. John D. Rockefeller Sr. was a key figure in the American oil industry and founded the Standard Oil Company in the 18th century. The Standard Oil Company is where the Rockefellers created a majority of their initial wealth. In 1911, Standard Oil was labeled a monopoly and was forced to split into multiple smaller, somewhat notable companies today. These smaller notable companies are Exxon, Mobil, as well as Chevron. Beyond Standard Oil, the family diversified amongst other asset classes such as real estate, banking, and other private ventures. A notable real estate holding of theirs is the Rockefeller Center in New York City. The Rockefeller Center is a massive skyscraper that houses commercial space as well as entertainment and shopping space. They also own about 1,600 other properties and 14 luxury hotels. Amongst that, they own 40 luxury yachts, 8 private jets, and a somewhat well-known bank named Chase Manhattan that holds $55 billion of their cash reserves. But the big question is, how did the Rockefellers' wealth stand the test of generations when 60% of wealth is eroded by the second generation and 90% by the third? A testament to this stat would be the Vanderbilt family, of whom have eroded most of the family's wealth as of current. The answer? Permanent life insurance and irrevocable trusts. There are 4 key terms to consider when we talk about an irrevocable trust. The first is the grantor, the person who opens the trust. Then there's the trust itself, and then there's a beneficiary, the person who benefits from the trust, and finally there's the trustee, the person who looks over and manages the trust. Now there's also some key terms and considerations when we talk about a permanent life insurance policy as well. A whole life policy accrues a borrowable cash balance tax free. They exist for your whole life, and when you pass, as long as you paid your premiums up until current, they pay out a death benefit to your elected beneficiary. You can also contribute above and beyond your premiums to further increase your borrowable cash balance. So, John D. Rockefeller Sr. came up with a strategy with his accountants and lawyers of borrowing against the overfunded whole life policy to buy assets. This was ultimately to create his own personal bank. He would then pay back the cash balance that he borrowed over time, and then once it was paid off, he'd go and do it again to accrue additional assets. An example of this would be borrowing against the cash value of a permanent whole life policy. You then buy a large multifamily asset or hotel that's distressed within the irrevocable trust using those cash value funds. You then fix up the asset to what the market is or the market value. You refinance the asset to pull back your initial investment, and then you pay back your whole life policy with that refinance. So, what you've done is created your own personal bank while building up assets within the irrevocable trusts that cash flows and is tax free. Consult your CPA before doing this, but the reason why it's tax free is because you're borrowing against the insurance policy initially, which is a tax free event. You then refinance, which is a tax free event, and then the uncaptured capital gains of the multifamily asset or hotel is tax deferred because it's within the irrevocable trust and you're not selling it. The only thing that's not technically tax-free is the cash flow that's spitting off from the multifamily or hotel. But even though it's not technically tax-free, there's a lot of methods to reduce your taxable burden down to zero because it's real estate. It's all tax-free. An overview of this is you have your grantor that opens the trust, you have the trust, you have your beneficiary, and then you have your trustee that looks over the actual trust. So what happens if the grantor all of a sudden dies? Well, what happens in that instance is the life insurance death benefit would then pay out to the irrevocable trust. The trust money from the payout would cover any final expenses from the grantor. The assets acquired in the trust would remain untouched, continuing to churn cash flow, further increasing the wealth of the family that remains. However, this method alone doesn't prevent the erosion of generational wealth. So, what the Rockefellers did, which was a major key to keeping this family pot compounding, is within the Rockefeller family, in order to be a beneficiary of the trust, you must have a permanent policy with the beneficiary being the original irrevocable trust. So it's like a diagram. What happens is you have the grantor, right? They die, and the grantor is the one that opened up the trust. They die, and then that pays out a life insurance death benefit. That death benefit goes to pay whatever is left of the grantor's expenses. Maybe that's funeral costs, maybe that's credit card bills, whatever it is. Then there's a residual that goes back to the trust. Now, that residual that goes back to the trust is then used to purchase additional hotels, properties, banks, the Rockefeller Center, private ventures, whatever it may be. Now, with all those assets, it's going to spit off cash flow every single month. That cash flow then goes to the beneficiaries. Now, what happens if you have a beneficiary that's a total F up, right? They are required to open up a life insurance policy of their own with the irrevocable trust being the beneficiary. So when they pass, then the process repeats, and this whole thing compounds and compounds and compounds. So you might be wondering, final thing, you might be wondering, okay, this is great, but where's the trustee come in? So the trustee is up here. Watching over this trust. They make sure that everything within the trust that was set in stone initially stays true. So that way this can continue to compound and compound and compound until it's worth $360 billion. Thanks for watching. If you liked this video, please like it and subscribe. And then also, if you want more of this content, please comment down below. Also, if you're local to the New Hampshire area and are in the real estate market, don't forget to shoot me an email at portercap01@gmail.com, and I'll be able to go ahead and get you a deal of your own, so that way you can start this investing journey.